So let's talk about Warren Buffett's dividend strategy.
He invests in dividends?
No, he's a growth guy.
Yeah. That's right. I thought he was just, buy low, sell high.
Yeah, that's all he does. That's right. How often does Warren Buffett sell stock?
I mean, not very often at all. When he does, it makes a lot of news because he is known, I feel like, really amongst many other things, but is like the long-term strategy, buy and hold. Like or he'll continue to purchase more shares as his income is increasing with all this.
It's very interesting because the things that you hear about Warren Buffett, stockpiling cash, and there was always news like how much cash does Warren Buffett have?
What does that mean?
Yeah.
And then what's he buying?
How often does he sell? Because that's a big Warren Buffett's selling. What are we supposed to do? So that it's very interesting when you hear the headlines because it's very seldom is it, Warren Buffett's new picks for 2020, whatever, or nothing like that.
No,
you never see like his take on XYZ investment. Like headlines you've never read.
No, because he just doesn't he's slow and steady.
Yeah.
He's the opposite of hot take.
Yeah. What would he be like? The boring
Slow
take?
and boring.
Yeah.
He's the crock pot.
He is the tortoise. Right?
People say dividends don't grow. I said, have you heard of Warren Buffett? And they're like, oh, yeah. So it does have growth, just a different kind of growth.
Yeah. Well, if you're enjoying the podcast so far, subscribe.
Wow, you're way ahead of schedule with that this time. Nice.
Yes. All right. So let's talk about what people get wrong about Buffett. We've already talked about that. That he's the growth guy, he's the hot take guy. What's the flashy stock? What's the market doing? Very seldom, even when the market's like in a pandemic or the 2008 recession, the bubble burst, Buffett's like, what? Yeah. I mean, the crazy thing is, I don't know what war was going on. I don't know. It was in late 20s or maybe it was during the bubble burst in 2000. I saw an interview where he was being interviewed by somebody who was really panicking, and I think they wanted to pull out some emotion from him.
Yeah.
And right in the middle of the interview, Warren Buffett goes, do you know what the number one selling candy bar was in 19 whatever during some war? And the guy's like, and he was taken off. He's like, no. He goes to the Snickers. He goes, you know what the number one selling candy bar was last year? Snickers. He goes, some things don't change.
Yep.
And his point was, you're getting all worked up for nothing. Like, just take a deep breath. Things are going to be okay.
Right.
And I think that's his number one gift. You don't panic.
Right.
He's been in it so long. He's seen so much. And he knows time is your best friend in investing. Like these irrational thoughts and, switching companies every couple months or whatever. Like that's how you lose a lot of money.
Chasing the yield.
That's right.
He chases solid companies.
So let's talk about that. What is his real dividend strategy? What's he do?
He's buying great companies that have a history of, continuing to reward the shareholder through dividend. I recently listened to an interview of him and he was like, I spend almost twice as much time researching a company's balance sheet than I do anything else. He's like, all that other stuff is secondary, but if they have a great balance sheet, they're a well-run company, they've got some type of strategic advantage over their competitors, that's the type of companies you want to be in.
Predictable cash flow. It's one of his things. Predictable cash flow.
Mm-hmm. I love cash flow.
I love predictable.
I don't know too many people that are like, don't talk to me about cash flow. Most of the time it's like everybody wants growth, but they want momentum growth. Like the grand slam. As fast as I can swing the bat, as fast as the ball is going to go, or even faster.
Yep.
And like shoot me some growth that way. Warren Buffett's like, what? Don't talk to me about hitting a grand slam now. I want to hit a grand slam over the next decade. Because a decade grand slam is much more advantageous than a 1-year grand slam. Mm-hmm. And I think that's where he's not greedy, looking for that short win. I think he's looking for that long-term win, which way outweighs the short-term win. Because most people get that short-term win, short-term loss.
Right.
Yeah.
And you continue to think, it's going to keep going up. When do you ever get, when you're playing that game of get like growth, it's when you sell to capture any of that gain, or do you keep it long term? If it came quick, you could probably leave quick.
That's right. So another big thing about him is he loves dividend growth, not just yield. So one of his big aspects is in looking in the balance sheets and going, okay, is this a great company, reputable? What's their balance sheet look like? Can they sustain increasing their yield year over year? Is their cash flow strong enough? Can I make it better? First of all, because that's what he's saying that, can we go in and make an impact on this business and take their revenue from here to here so they can impact their dividend growth even more?
Right.
So, because he's not just, hey, I don't want to buy a stock for $10 and sell it for 30. He wants to buy a stock for $10 and sell it for 300, or hold it till it's 300 and bank all those dividends. And now instead of having 1 billion shares, he's got 7 billion shares.
That's right.
Or something crazy.
Yeah.
He's definitely the long-term guy. What else?
I mean, that's what he's done with Coca-Cola.
Once we're done with about every stock he's held.
Yeah. But I mean, that one specifically
Yeah.
is just crazy how long he's had it.
So he's definitely let time compound the income.
Mm-hmm.
So he's a patient investor looking for strong balance sheets, looking to let time do its thing.
His favorite holding period is
Forever.
forever. I love that one.
I think, at the end of the day, where Warren Buffett differs from a lot of investors is that generational mindset. Let's not just figure out what I can do today to be better, but let's figure out how we can position ourselves to impact the next generation. And that's how I think he approaches investing. He's not just buying a stock because he wants to sell it for twice its value. He's buying it because he knows the stock's income is going to affect the other strategies he's going to be investing in, some other stock in whatever time frame, because he thinks so differently. Now, we've already made a note about this, but what's one of the most, I think, impressive things about him when it comes to understanding the markets? Warren Buffett.
Well, he doesn't do the common thing of buying low and selling high per se. He doesn't listen to all that crazy noise and try to get on the bottom and get on top.
I think he is not distracted by the market, like the candy bar.
Yeah.
Analogy that he talked about. He's like, who cares about what's going on in the day to day? Because he's like, year to year, we kind of know what the market's going to do.
Right.
And he's like, why are you getting, all bent out of shape? Because he's focused on the books. When you understand the financials, which are not emotional, they're number driven, the reality of what's going on in that company. So when you see a market go through turmoil or some bad thing happen with whatever, and it affects the market, he's like, okay, big deal.
Right.
Short-term little setback, which is driven by emotion. So the realities are he's viewing information stocks completely different than the average investor.
Like you were saying, the noise isn't there. When you're thinking outside of all of that, the books, they don't lie. A great company doesn't suddenly become a really bad company because the market's doing something.
Yeah.
So I think he doesn't even care what the stock price is, really. Or it comes very, very long down the line, much later in his decision making. It's not, he doesn't start with, ooh, is this the opportunity to buy this stock? It's like, no. Let's go research the company. Let's find out what's going on. And then we'll see if it's an opportunity.
He looks at the things that drive sustainability, right? Not just now. Because if you go and chase that high yield, there's probably some sort of a strain somewhere, right? Because the company's doing something he doesn't get caught up in that shiny stuff. And
he's getting to know the business.
He's not going to do a short, he's knowing the business. There you go. If you watch the last podcast, if you know, you know. Sorry, Cal, go ahead.
No, I was just saying it's also super helpful that the tenure, the amount of cycles that he's been through, the 40, 50, 60, 70 years of investing, he's seen just about everything possible, whether it's pandemic, wars, whatever it is. You can say, okay, this looks like it did 20 years ago. Let's look at that and see, okay, that's about the same. We're just going to ride this through and see how it works out. It's comforting from his vantage point that he's been through all these cycles and can take the emotion out of it.
What advice can you give a client, an investor? Because the next thing we're going to talk about is what we can actually adopt from his strategy. However, let's take a step forward into the life of the investor. And, they're in retirement, they've got dividends, they're doing their thing, and the market drops. They don't have the experience, even if they do have the experience. Your life, your income is on the line in the market. How do you feel? What do you do?
Well,
You have to separate those two.
right.
How you feel and what you do.
Right. Well, that's a good point.
Hey,
We can do a whole other podcast on that.
You open it up, you see red, the emotions are going to be there. But you have to, I say, go back, look at the statements, look at the history of those companies that you're invested in. Remind yourself why you even set up a dividend strategy. Because these companies, if you set it up correctly, the companies you're invested in, they have this long history of paying, increasing. And so then you can start going through that research again if you need to remind yourself of why.
Well, and the one thing that does help when there's the highs and lows, right? You go chase the shiny thing. We're all guilty of it. If you solve for your income and you can go chase some shiny stuff, fine. But the difference between dividend paying stocks and the ones that are shiny but doesn't have that income is when those markets go up and down, you've got the dividend to fall back on, right? So I don't want to say that's part of what Warren Buffett has in his head, but I know for me, sometimes because I'm a real human, occasionally you get, oh, wait a minute, I want to go.
I'm a real human.
I'm a real human. I'm glad you can feel my
I love
ears
these
up.
isms.
He's not a
I'm a real
robot.
human.
I'm a real human, But no, I was just going to say that you can rely on that income and those companies that pay you when everything's great and when it's not so great, right?
Well,
that helps you stay in when we're going down the roller coaster.
Remember whenever you were at your job, if you're in retirement, there were years that the company, for whatever reason, it just got sideways. Maybe you didn't hit all the goals and things like that. But guess what you still got? You still got your paycheck each month or twice a month. Maybe the bonus looked a little different, which would be that growth side of it, right? Your bonus check looks a little different. But your salary's still there. You're still getting paid. You're able to, live your life. So reflect on what you do know.
Right.
All right. So what can we actually copy from Warren Buffett's strategy?
I mean, number one, pick high quality companies.
Mm-hmm.
He doesn't pick bums.
Know their business. Learn those companies' business. And are they sustainable?
Know your business.
I know. It's the thing. It kind of matters.
We're going to get her a t-shirt.
Yeah.
know your business.
No, but no.
And on the back, stay out of mine.
So not. Ignore that context. No, but know the companies. Make sure you've looked deeper than just the headlines.
Yep. What else?
Just the dividend growth. Long-term dividend growth. Are they ticking up? That slow, boring thing.
I think that's sustainability of the dividend, making sure there's a history and a cash flow. Look at the cash flow of the books. Just like Warren Buffett, I would spend just as much time understanding the business, the model, how they're making money, what the projection is of that line of business.
Yeah.
That's more important than what the price of the stock is, even if it's on a decline and you own it. Because sometimes the market's getting pulled down for factors that the company has nothing to do with.
Yeah.
Like the pandemic, the world shut down.
Right.
All stocks fell in the tank. And yet certain companies, like the online companies, were exploding right away. And yet their stocks weren't necessarily, and those stocks did rebound very quickly.
Really quick.
Yeah. But the reality is whatever was happening as a result of the world changing in an instant, that everything was okay. But I know people were selling and panicking and
do the companies have an emergency fund the way that we need to have an emergency fund? Have they thought about, the solid ones, the answer is yes, but some of them are hanging on by a thread. You got to know.
Yeah.
Do they have an emergency fund?
Well, and sometimes in those scenarios, just like the one he was using with the pandemic, you had these companies that their valuation, their stock prices just got obscenely high for no reason other than, oh, everyone's just going to start work. I think of the gym stuff. That's exactly where my mind was. Peloton goes so high. Everyone's going to adopt working at home. No one's ever going to go to a gym. And literally a year and a half later, it's 90% drop.
They're ready for bankruptcy.
Yes. They're strategically trying to figure out how to strike up new partnerships to even create any cash flow. And they're really moving more outside of equipment. It's fascinating to watch. So you got to really understand the companies that you're investing in, because if they don't have cash flow today, all of a sudden their stock price is popping and it's going super hot, that doesn't magically create cash flow.
That's pretty good. All right. Yeah. So any closing thoughts? We've talked in circles and said,
well, and I feel like a lot of people know this, but geez, when you do get to retirement, that chasing a percentage and shiny things gets a little bit scarier. It is really cool when you know how many apples are falling from your tree, right? And you know that those are going to come every stinking year and you're in retirement and you can predict that, right? percentages don't pay you when you're in retirement, right? They just don't. Whereas income does. So I feel like people associate dividends with that, but how do you apply that to your rest of your life? And I just had to sneak that one in there.
Yeah. Just be careful what you're investing in. I feel like that's my drum. Just be sure you know what you're investing in, where their income is coming from, evaluate the company, and do your due diligence before you ever put your money there.
Here's another ism. Is it good in 5 minutes, 5 hours, 5 months, 5 years, and 5 decades? Warren Buffett, he was focused on the decades. So when you make a decision on a stock, don't just look at like 5 minutes or even the 5 days or 5 months, you know?
Can you tell me what stock's going to look good in 5 decades?
Warren Buffett can. I can phone a friend.
He's still going to be
I bet we can get pretty close.
I know.
We can get a handful of them for sure.
Yeah.
Mm-hmm. That'd be a fun show. What stocks are going to look good in 50 years?
I should have known you were going to
Hold us accountable for it too.
Yeah.
Exactly.
Because all of our viewers will not probably be around in 50 years.
Fair.
I hope I'm around in 50.
Yeah.
But some of these companies,
Well,
think about it. You go and look at the ExxonMobil, 1882. Were they talking about it? You know, in 1882, were they
wisdom?
talking in 2025? Right? Aren't we in 2025 for a couple more
I think
days?
great CEOs are.
Yeah,
Yeah.
exactly.
Great CEOs are less worried about the quarter and
That's
they're
right.
worried about the long-term vision
Yeah.
of the company. We have a whole podcast around Amazon and how
Yeah.
for years Bezos was writing, they were exploding as a company through cash flow and revenue and all these metrics that would seem to create a growth in your stock price. Yet the stock price was falling
Yeah.
because the market didn't like how he was
But-
reinvesting cash.
But I think he figured some
I think
things
he
out.
figured it out.
a couple things.
Couple things.
That's it.
All right. So hopefully you've learned a lot on the show today. If you want to dig deeper really into how Warren Buffett does what he does, we have this awesome dividend starter kit. You can get absolutely free. Just subscribe to the show, go down to the comments, put in dividend starter kit, and we'll get that to you absolutely free. God bless.